Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we've got Ernest Chan here back for his second presentation, another webinar on risk. This is actually part of the BMT 4-year anniversary. During the month of June, we've got 16 very special webinars all month long. I think this is number 10, and there's 6 more to come. During each of those webinars, we have some really fantastic prizes to be given away. In this webinar, I'm giving away 10 autographed copies of Ernie's brand new book, Algorithmic Trading, Winning Strategies and Their Rationale. Some of the bullet points that Ernie wants to hit on today include why the Forex market is particularly dangerous for mean reversion traders, a look at normal versus tail risks, a look at the leading risk indicators for various markets, and an in-depth discussion of factors of risk management. At the end of the presentation, there's going to be a Q&A. Actually, Ernie has also said that we can take questions as we go, so I'll look for those that are relevant. Once we're through with that, we're going to move on to the quiz questions to give away the 10 books. So pay close attention to what Ernie has to say today, because the quiz questions are directly based on the content that he will be covering in today's webinar. Webinar is being recorded. I'll post the recording on YouTube and BMT sometime tomorrow. Please do me a favor, give us a thumbs up if you like it. And with that, let me turn things over to Ernie. Are you there, Ernie?
Yes.
Okay.
Hi. Okay, thank you, Mike. Let me try to get my screen up for everyone.
Yep, we can see
it.
Thanks,
Are
Ernie.
you able to see my screen? Okay.
Yes,
Great.
looks good.
Thank you. Thanks all for coming. If you have come to my previous seminar, I welcome you again. This topic is a little bit related to what I talked about previously, which was also on risk management and capital allocation using Kelly formula. But this time, we will focus on the risk specific to the Forex markets. For those who don't know me, I have been a quant for a number of investment banks since 1997 and hedge funds. And currently, I run a hedge fund focusing on Forex and futures trading. And I'm also an author of 2 books. The previous one was Quantitative Trading, and as Mike said, the newest book is Algorithmic Trading. And if you like to connect with me, please do visit my blog, epchen.blogspot.com. There are many people who would ask questions, and I would answer them. It's a lively discussion there. So without further ado, let me launch into the topic of the day, which is talking about risk inherent in mean reversion strategies. Now, I confess that I am mainly a mean reversion trader. Despite being a futures trader, I still find it most comfortable to run mean reversion strategy because these strategies tend to have a very high consistency. I like to see my strategy make money most days rather than make money once in a blue moon and lose money most days. Those would be typical of momentum traders. For me, I like the comfort of knowing that my strategies are consistently making money most days. And as a mean reversion trader, I like what I would call normal volatility. But I dislike abnormal volatility. And you would too if you are a mean reversion trader. What is normal volatility? Well, normal volatility is refer to those returns that fall into what statisticians call a normal or Gaussian or a bell curve distribution. It's looked very nice. You must have seen it many times somewhere. Now, why do we, as mean reversion trader, like normal volatility? That's because prices that with normal volatility often mean revert, because those fluctuations are typically just due to liquidity demands. Somebody want to sell for their own private reason, and you would want to take the other side of the trade. And then once the guy or girl has stopped selling, you can sell back your inventory at a higher price. So this kind of a normal market volatility is good for mean reversion trader because they just come and go all the time. The price go up, go down, and follow a rather normal pattern. That's how mean reversion trading makes money. If the market doesn't move, obviously we can't make money. But if the market moves as like a random walk, if the returns is distributed like in a bell curve, it's easy to make money because what goes up must come down. And we distinguish this kind of temporary liquidity demand-driven volatility from volatility that are driven by news or fundamental events. Those events generate what I call abnormal volatility. Some other names that are given to abnormal volatility is tail risk. You hear that a lot, especially on around 2008. There are a lot of tail risks at that time. Even in 2009 or even 2011, almost every year there are some events that fall into this category that we can call tail risk. Other people might call it black swan risk. You might have read Nassim Taleb's book, Black Swan. That's where he coined the name for this kind of event which fall way out of this bell curve. Okay, and yet others might call it Six Sigma events. Sigma refers to the standard deviation. So if you have an event, a return that falls out of 6 standard deviation from the mean, theoretically it should never happen. It should happen once in the lifetime of the universe. But it happens, in our lifetime at least several times. So clearly that means that the returns distribution is not normal. So we call these Six Sigma events. We might also call these events that are at the 6 standard deviation, we might call them fat tails. They are called fat tails because if you are if you are assuming that these distribution of returns is normal, the tail would be very thin. But the fact that the probability is much higher than what we would expect in a normal distribution, that means the tail is much fatter than we expect. That's why we often call them fat tails as well. Now, what are the causes of this abnormal volatility? I already mentioned it. The cause is not because somebody just wants to sell because of their private concern. It's usually because it's driven by news or fundamental events. News could be, for a stock, could be corporate news, could be earning announcement, could be management change, it could be a merger and acquisition, could be a lawsuit, could be government regulatory actions. Many kind of news can drive abnormal volatility in a stock. And even for futures or currencies, you could have, just like yesterday, we had a fundamental event. The Fed chairman said that, they have a program to reduce QE, and that causes the market to tank, and that's a fundamental event, and that causes abnormal volatility. Now, for us, mean reversion trader, these fundamental events, these kind of abnormal volatility is very bad because, number one, it doesn't usually mean revert. When a fundamental event occurs, it drives the prices to a new equilibrium. It's not going to mean revert very, very easily. And also because the magnitude is so large. Typically, a volatility driven by fundamental event is much larger than a volatility driven by just normal liquidity demands. And so as mean reversion trader, even though day in and day out we try to make consistent profit, but if there's one big event, one big black swan day comes around, all our hard-earned money over many, many days, maybe many months, could be wiped out, in a day. I've seen that before. It happened to me. We had maybe whole year profit can be wiped out in one single day because of this kind of event. So the focus of this particular talk is how do we avoid that kind of event, and particularly how to avoid that in the currency market. And I will talk about what makes currency market particularly vulnerable to this kind of events. Oh, and by the way, as Mike said, if you have questions, please feel free to type it in, and Mike will, tell me if the question is relevant, I will answer it right away. So you do not need to wait until the end of the talk.
Ernie, I've got a quick question.
So,
I don't know if you're going to cover it later or not, but have you done any studies as to how often the Six Sigma events are actually happening in the markets?
not any formal studies, but just from my personal trading experience, I can say, let's just looking back at the last, let's say, 2.5 years
Right.
of my experience trading Forex. It happened at least once a year.
Right.
This year, it hadn't happened to me yet, but I'm expecting it at some point.
Right.
Yes. So, and I will talk about one major event that happened in 2011, and it happened to me and a lot of other Forex funds, and I'm going to talk about that. Yeah. So, well, before I drill down on this how to prevent this risk and why Forex market is particularly vulnerable, let me contrast mean reverting strategies with momentum strategies. Why is it that I'm concentrating on risk with respect to mean reverting strategy as opposed to momentum strategy? Well, mean reverting strategies are particularly prone to tail risk because of this. In a mean reverting strategy, if the price is low, we buy. Okay, well, that makes sense, all right. If the price goes lower after we bought it, we should buy even more, right? Because, mean reversion, the lower it is, the better the price is, the more we should buy. Even though at that point we would be losing money. So in a classic mean reversion strategy, as the price keep going lower, we should keep increasing our position, and there's no bottom to it, basically. And let's say some people say, well, why don't we impose a stop loss? That should be easy. But the problem is stop loss is unnatural and illogical to mean reverting strategy. Why would you suddenly liquidate your position when the price gets even lower? By what logic? It's completely arbitrary. And in fact, I have done backtests on many mean reverting strategies. By imposing stop loss, you will always decrease the return of a mean reverting strategy. You don't believe me? Try it on your own mean reverting strategy. Try to compare your return with or without stop loss. I will bet you that you will find that by imposing stop loss, you will decrease the return of your mean reverting strategy. Now, that doesn't mean that you should never use a stop loss. I have a rule which says that even though in my backtest stop loss would decrease my return, but I would impose a stop loss that is when the return is lower than I have ever seen in my backtest. In other words, in my backtest, I have never would have triggered this stop loss, and I would impose a stop loss at that level, because then, first of all, it won't affect my backtest, right? This was never triggered. But on the other hand, it really protect me from being wiped out. Okay, so I'm not saying that stop loss should not at all be used in mean reverting strategy, but I'm saying that you should not use it too frequently. In particular, you should not use it at a level that is reached in your backtest. So I'm not going to talk more about stop loss in this lecture because I don't view it as a particularly useful tool.
But would you consider what you're describing as a disaster stop or a catastrophic stop, something that, like you said, you have not seen in your tests, so therefore it's outside the perimeter, something's not right, and that's why it's at that level?
Yes, you can describe it as a catastrophe stop, correct. Yes.
And let me also ask, because I know that there's people out there thinking, and by the way, I agree with you, but what about all of those people as far as the martingale approach and adding to losers? How do you quantify the difference between? Well, I guess my belief is that if there's a plan ahead of time to scale into a trade, then it's not really adding to a loser. If you still think the trade is correct, it still is doing what your original premise was, then it's okay to add if price goes against you. Okay. What do you think? How do you distinguish between martingale, which is basically pyramiding as it goes against you, and adding more and more and more to what you've described on your screen?
Well, when I say that we should add more, it is under the premise that this is a mean reverting price series, right? So a normal martingale, if the prices are doing a random walk, it will not work. By adding to it, when it loses, you will lose everything before you make any money. But this particular method only works if you are assuming that the price series is mean reverting. And how do we know it's mean reverting? Well, by back test, we say that, well, in the last 10 years, it's mean reverting. So chances are it's not going to suddenly start to go random walk on us going forward. So that's the premise.
Okay. So at a high level, does that mean that, I'm not sure what time frame you're trading, but let's say that you are trading daily bars. Are you looking to maintain your strategy over range days, but if a trend day comes in, like today, for example, and we see a big drop down, is that when you make sure that you possibly don't even, not only not add, but also exit? How do you approach that?
Well, it is very difficult, if not impossible, to tell ahead of time whether this is going to turn out as a trend day or a mean reverting day, right? I mean, after the fact, everybody would tell you this is a trending day. But, at 12 p.m. today, how do you know that the market is not going to end up 5%, 1%, right? We don't know that. So, so my approach would be that, if you think that this is overall a mean reverting system, you will trade it like a mean reverting system no matter what the day is shaping up to be. The stop loss is there to protect us from bankruptcy, essentially.
Right.
And it's not going to be used frequently. If you use it once, chances are you would have to throw away the strategy completely because it basically violated your backtest. Because in your backtest, you have never reached that level. Now you reach that level, so your backtest is kind of invalidated by that one sub loss.
Okay. But one last point, and then I promise I'll let you continue. I just want to get clarification and have you emphasize that just because you're not using a stop doesn't mean that you're not using some other means to tell yourself to exit the position. Is that right?
That's right. Yes, okay. That's actually the idea of this talk is to, what you could do. And hopefully you can do it preemptively. You don't have to wait until you already lose 5% to do that. Yeah.
Okay, thanks.
Yeah. Okay, so to contrast mean reverting strategy with momentum strategy is basically to reframe it, why are momentum strategies less prone to tail risk? Why are we less afraid when we are trading momentum strategies to a day like today or someday like back in 2008, let's say? For momentum strategy, if the price is high or is higher than some benchmark, we buy, right? So that's what the momentum strategy is supposed to do. If it goes lower, on the other hand, after report, we would sell the position. That's very natural because, clearly the momentum has reversed. We should either go flat or maybe even reverse our position, reverse the sign of our position. That's what momentum strategy is supposed to do. So, in other words, there's a natural stop loss in a momentum strategy. Whenever momentum reverses, and therefore we are losing money, we should get out of position and maybe even reverse position. So that stop loss is perfectly natural, perfectly logical, and most importantly, in the back test, you can show to yourself that a stop loss will improve for profitability. So everything is good. So stop loss has its almost sacred place in a momentum strategy, and you should do it. So therefore, with that stop loss, you are not as afraid of tail risk. Now, let me mention one caveat to that. The caveat is that if you're trading stocks or some other markets where there's an overnight gap, the stop loss is not going to protect you, right? Because you can't sell during the time that the market is closed. When the stop loss is only useful when the market is open practically continuously, like in Forex or in most futures. Not all futures, but most futures. You have a continuously operating market. Now, even for Forex, of course, on the weekend it's closed. So, I would think that if you're really risk averse, make sure that you're flat before the weekend, even in Forex. But so, this is an important caveat, is that yes, momentum strategy typically are less prone to tail risk because you can use stop loss, but the stop losses will not be effective if you have a long gap in that market. But that's, I think, a lot of you would have figured out already. So let's move on to the next point. So like we just discussed, we don't really want to use stop loss too much to protect ourselves, but we still want to avoid tail risk. In particular, we want to avoid tail risk ahead of time, not when we are already in a position. So if there's a magic indicator that we could use to predict the occurrence of these kind of outliers, this kind of Six Sigma event, this kind of black swan event, it would be great, because then we can avoid many deep and lengthy drawdowns. And these are the indicators which I call leading indicators. Leading risk indicators. And I'm going to talk about two in this talk. But before I talk about them, once again, let me do a sidebar or a detour, which is, how do we measure, what's the quantitative measure of a tail risk? We keep talking about black swan event, tail risk, Six Sigma, but when you look at the distribution of returns of a system, of either of a strategy or of a price series, or of a return series, what is the quantitative measure of how much tail risk there is? Well, it turns out that there's a quantity called kurtosis. Kurtosis is proportional to the fourth moment of the returns distribution. So if you plot the returns like in a histogram, you can compute the fourth moment, and that's will feed into a formula that shows you what that is. That's the kurtosis. The nice property of the kurtosis is that it's zero for Gaussian distribution. So that's very easy to remember. If it's Gaussian distribution, there's no kurtosis, no tail risk. And if you have a fat tail distribution, kurtosis will be very high, will be much greater than 1. So kurtosis measures how fat the tail of returns distribution is. And that's the measure that we are going to use to see how risky, how risky in the sense of tail risk a particular strategy or a particular market is. So here, for example, is a normal distribution. You can see that it has a very nice bell shape. The x-axis are just the returns magnitude, and the vertical axis is the number of occurrences with that particular return. So that's a returns distribution. Very, very nice bell curve. And here is a fat tail distribution. It has the exact same number of occurrences of returns as before. If this is a daily bar, it has the exact number of days that we are used to generate this distribution. But you can see that it is very thin in the middle. Within 1 standard deviation, there are not too many occurrences, but a lot of the high big return, the extreme returns, are still fairly well populated. Okay, it's hard to tell because it's so spread out. But believe me, you can find that there are many more occurrences of these returns at the 2 or 3 standard deviation level compared to the previous chart, which doesn't. So that's just a graphical illustration of what a return with high kurtosis it looks like compared to a normal distribution. Now, why is that having this kind of leading risk indicator particularly important for Forex trading? Why is this concept of fat tails particularly important for Forex as opposed to, let's say, equities trading? It turns out that Forex market has a rather nasty quality. Nasty to us mean reversion trader. Okay, maybe favorable to momentum trader, but very nasty to mean reversion trader. And that is because the normal volatility in Forex typically is lower than, let's say, in the equity index. It's not uncommon to see S&P 500 index go up and down 1% a day. Okay, but it is rather uncommon to see, let's say, the Euro USD currency pair go up and down 1% a day. It's occur less frequently. But the problem is, so that's already a problem. Why that is a problem is that, well, as mean reversion trader, we like high normal volatility to make money. If it doesn't move much, we don't make as much money unless you increase the leverage. Well, you say, but the problem is if you increase leverage, you run into the second problem, which is that the extreme volatility in Forex is the same as the extreme volatility in equity. So, once in a blue moon, equity market does move maybe 3-4% a day. Okay, it happened before. Sometimes it moved 5% a day. And what about in Forex? That happened too. So both of them has the same amount of tail risk. Both of them have days where it moves, 3, 4, 5%. So in a more succinct way of putting this is that the kurtosis in Forex markets is much greater than the kurtosis in the equities market. And that's really bad for mean reversion trader because, while we, if we apply the same leverage to a strategy in Forex versus equity, we make less money in Forex versus in equity because of the lower volatility in Forex, but we lose the same amount of money when there's an extreme volatility, extreme event in Forex versus an extreme event in equities. So that's very bad, and normally people try to compensate for the low normal volatility in Forex by increasing the leverage in a Forex strategy. You have heard some crazy numbers. There are brokerages that allow you to apply 100 times leverage in the Forex trading. I totally don't recommend it, but they allow you to do that sometimes. And that is very bad because even though normally the Forex doesn't move as much as equity index, in extreme situation they move just as much. And so the higher leverage is going to absolutely kill you in the Forex market. And so let us look at some actual examples. This is all a bunch of theories so far what I talk about. Let us look at some actual historical examples. In 2011, if you might remember, in August of 2011, I think it's the S&P rating agencies downgraded the U.S. federal debt in August, and following that, in the next few months, there's a Eurozone debt crisis. That Greece was constantly on the edge of default, and so what happened? Well, that two events combined to cause the average Forex fund to return a negative 6.2% that year. So, the average fund lose money. And not only that, but their asset under management dropped 40%. That's a big number. And this is just talking about average. I mean, obviously some fund just closed down naturally. I mean, even big, huge fund that was run by John Paulson, I think, dropped over 30% in return that year. So you can see that everybody suffered huge tail risk in that year. And if you look specifically at a particular currency pair, like the Mexican peso versus US dollar, normally the volatility is 17% per annum. Comparing to the volatility of the S&P 500 index, or in this particular case, the E-mini, that's volatility was 25% per annum. So normally the currency, the peso, has a lower volatility than the stock index. But in 2008, the biggest daily move of the Mexican peso was 10%. In one day, and this is not analyzed, in one day it moved 10%. Whereas the biggest daily move of the E-mini in that day, in that year, was only, quote unquote, only minus 9.6%. So you could see that this illustrates what I was talking about. The normal volatility of a currency normally is smaller, but during an extreme situation, they move just as much as the equity index. Now, why did I suddenly pick up the example of the peso? What's the big deal about peso? Well, it turns out that the peso is the most liquid of all emerging market currencies. And nowadays, traders use it as a proxy for emerging market risk. So when they think that there's emerging market, there's a risk there, maybe Greek is going to default or China is slowing down or whatnot, what they do is they sell peso. So it's very interesting that peso, the Mexican economy might be humming along, it might be doing perfectly fine, but all of a sudden the peso would drop 2%. Why? Because traders worldwide is using peso as a proxy for emerging market risk. They just dump peso no matter how the Mexican central bank is reacting, how the Mexican economy is doing. They just use it as a proxy for all of emerging market. So that's why it's very interesting to look at this behavior. So here's a graphical illustration of what happened in 2008. It's not a pretty sight, and if you look at the what happened in 2011 also, it has another steep drop. Both times has practically nothing to do with Mexico, but a lot of things to do with either the US economy or the European economy. Okay, so let's look at some comparative numbers. There are two columns. Well, first of all, I compare three instruments: the Mexican peso, the ES, the E-mini S&P 500 index future, and HYG. HYG is the high yield ETF. It's yet another risky asset class. Okay, it's all the high yield corporate bond in the US. That's the ETF that traded. It's often again used as a proxy for of risk aversion. So first, let's compare the volatility of each of these risky assets. Normal volatility, 17% for peso, 25% for the equities market, much higher than the peso, and 17% for the high yield ETF. But look at the tail risk. One, I could have used kurtosis, but I also, here I use maximum drawdown. For the currency, for buy and hold position. Here you have a minus 37% maximum drawdown. That's pretty scary, but nothing compared with actually the equity index. Actually, it has a minus 57% drawdown, and the high yield bond fund has a minus 34% drawdown. Okay. Now, what are the bold numbers? The bold numbers is after we applied a certain leading indicator. I'm going to tell you in the next slide what that leading risk indicator is. Suppose you say that if this leading indicator is flashing red, I refrain from holding it. I exit my long position in the peso. How would it look like? Well, with this leading indicator, the volatility, the normal volatility dropped to 11%, and the maximum drawdown dropped to minus 25%. And similarly, the volatility dropped from 25% to 90% for the equity index, and it dropped to minus 32% for the maximum drawdown. And similarly, for the high yield, it dropped from 17% to 10% for normal volatility, and for maximum drawdown, go from minus 34% to minus 28%. So if you can achieve that kind of risk reduction, you should be quite happy. So let's find out what this risk indicator is, what this leading risk indicator is. Well, this is the anticlimax, because a lot of you must have known it already. This is nothing but the fixed index, the volatility index. Now that's very interesting. What's the rule? The rule is do not trade or hold positions in that particular asset, whether it's Mexican peso or US equity or the high yield ETF, if today's the fix go beyond 35. If at the market close today, if the fix is 35, liquidate all your positions. Don't trade tomorrow. Don't enter into any positions tomorrow. That's the simple rule. That's the rule that resulted in all this reduction in risk. So fix, a lot of people think, why this is interesting is that a lot of people used to think that fix is a contemporaneous indicator. They think, well, what's the use of fix? By the time the fix is up, we already lost a lot of money. But this quick study that I did just a few minutes earlier shows you that VIX is a leading indicator. It's not a contemporaneous indicator. It actually has some use for us traders. Okay, and the surprising thing is that this VIX indicator is not only useful for avoiding equities market risk. It is also useful to avoid Forex risk and high yield corporate bond risk. It's a general risk indicator that it has predictive power. Okay, now for those who don't know or forgot what the VIX index is, a VIX index is simply computing from an average of the call and put S&P 500 index option prices. So if the option prices are high, that means that people think that there is going to be high volatility going forward, and the VIX index is go higher. Okay, now my study is very flimsy, you might say. Well, just one rule. What about there's not a lot of statistical significance in your test. It's just free markets and with limited amount of data. Well, don't just rely on my work. There's also other more careful academic studies which support the same conclusion that the VIX index is predictive, not just contemporaneous. And I have cited one of the papers here. You can look it up. Okay.
So, sorry, Ernie, before...
Yes, go ahead.
Okay, I didn't know if you were going to keep talking about VIX or not, but today, for example, the VIX was up. I don't have my chart open, but I think it was around 21, which I also believe was the highest level for this year. So you're saying that, and this is still quite far from 35.
Quite far, yes.
But you're saying predictive. So you're saying that even though today we had a big down day, the VIX is far higher. And even though that if you look at this entire year, calendar year, pretty much every single time the VIX has spiked in the S&P, it has signaled a near-term low, and the VIX shortly thereafter retreats and we move higher. So I want to understand what you're saying, which is even though the VIX has risen, you still think that there's the increased volatility is mostly to the downside when it gets above 35. Did I understand correctly?
Right. Well, even with today's drop, I don't think that today's move can be really called an abnormal move.
Right.
It's not really a 6 standard deviation.
Sure.
Compared to what happened in 2008, what happened in 2009, what
right.
happened in 2010 during the flash crash,
Sure.
what happened in 2011 during the awful week in August. This is nothing. And the VIX agree with that sentiment. Say this is normal volatility, not to worry.
Okay, so I guess my question then would be, do you only see this behavior take place when the VIX is above 35, or does it still take place when the VIX is lower, just not to the same extent? Is there a pattern? Is there consistency, or is it really different just depending on this abnormally high VIX number?
Yes, I think that VIX is really important as an absolute measure, not a relative measure. So we cannot say that, well, just because the VIX go up from 15 to 20 or from 15 to 25, wow, it goes up 10 points.
Right.
Does that mean anything? My take on my study was that it doesn't mean anything.
Okay.
It's not whether it go up 10 points that matters. It's the absolute level that
Gotcha.
matters.
Gotcha. Yeah. Understood.
Yeah.
Thanks, Ernie.
Okay. Yep. Okay, so we have seen based on my one table of results that if you apply the VIX indicator to a buy and hold strategy on these 3 different assets, it does protect us. It will reduce both the normal volatility and, more importantly, reduce the tail risk. But what is effects on a mean foreign strategy? That's what we want to know. We are not buy and hold investors. We are traders. So what's more important question is, does it really help a minimum foreign strategy? Well, obviously everybody's minimum foreign strategy is different. So I can only quote one example, which is a minimum foreign strategy, again, trading the Mexican peso against some other currencies, maybe against US dollar or against euro or yen or whatnot. Okay, so at a high level, the strategy would be to buy the peso against the another currency when the peso is lower than the average and vice versa. You can imagine it as a Bollinger Band strategy. Buy low, sell high. Okay. For certain X, maybe US dollar or euro, this strategy can result in a fairly high Sharpe ratio. Okay, it's a Sharpe ratio of over 2. But at the same time, it has a fairly steep drawdown. The maximum drawdown can be as high as 15%. And I backtested using the fixed filter as a leading indicator, using the same rule that I described earlier. When it's greater than 35, liquidate, don't trade for the next day. This simple rule will immediately reduce the drawdown to 10% while maintaining the same Sharpe ratio. So that's very important, while maintaining the same Sharpe ratio. That means that it does not hurt the strategy in terms of its consistency, in terms of its profit, but it just reduces drawdown. And that's basically what we wanted. So that's very happy results. Now, okay, so enough about fix. I think the rule is simple enough. Everybody can understand and actually to apply it.
Right.
Let me talk about a little bit another indicator.
And I'm sorry to interrupt, but there's a few questions on the screen that I want to ask before we get too far away from the context of the question. So
okay.
Let me just take care of these questions real quick. JL is asking just a general question that you can answer if you'd like. How do you tell if a mean reverting strategy has a positive expectancy?
Well, if you back test it
right.
and it has a positive return, that's a positive expectancy.
So JL, I'm not sure I understand the question. Maybe you can reframe. Amelia is asking, in your opinion, what are the implications of positive or negative skewness in strategy returns, and how do they alter the aggregate risk properties in the portfolio?
Well, I assume that when you say positive and negative skew, you are talking about. Okay, let me ask you back a question. When you're talking about the skew, are you talking about the skew in the price series itself or the return series itself, or are you talking about the skew in the return of the strategy?
In the return series is the answer.
Okay. The returns, I guess I interpret it to mean the returns of the instrument itself.
Of the strategy.
Oh, of the strategy. Okay. Well, naturally, we want to have a skew positive. I mean, if your strategy doesn't skew positive, it's a pretty bad strategy, right? I mean, it means that it has a much more chance to lose money than to make money. And actually, that is the characteristic of a mean reverting strategy is typically that it's skew positive. It doesn't skew negative. For momentum strategy, it can skew negative because, as I said, in a mean reverting strategy, what we hope for is that a lot of times it should be overwhelmingly have more winning trades than losing trade. Even though the winning trade may not make a lot, but it should have a lot of occurrences of winning trade.
I'm not certain, but I think the question is more on how that skewness will affect the risk. Do you find that if it's skewed, far to one side or the other, that the risk is proportional, or does it, what's the relationship?
Well, skewness is not a particularly good measure of risk, because skewness in some sense is kind of telling you the expected return, which we have to be positive to trade a strategy. The risk is really in the fourth moment. Skewness is the third moment of a distribution, but kurtosis is the fourth moment, and that's really the measure of the risk, because it tells you that when even though everything might be skewing positive, everything might have a positive expectation, it's all good in normal circumstances. The fourth moment is telling you how bad can it get when you have a rare bad trade.
Okay, and Amelia is offering further clarity, saying that can we agree on the convention that negative skewness would mean the peak is further to the right?
No, I think positive skewness means that the peak is 10 to the right.
Okay. And arbitrage strategies would generally have a negative skew. Is that right?
I wouldn't agree with that. No, I think it has a positive skew for arbitrage strategy.
Okay. And Helder is making an observation just to confirm. So if you don't trade when the VIX is above 35, I think that he's pointing out that would mean that there's several months, 5 or 6 months in 2011 that was true. So you're not trading for a long time.
Yes, that might not be bad.
Right.
Yeah.
Right. I mean, I guess that's the point, right? I mean, if you have something that's proven that in a certain condition you're taking an extraordinary risk, then don't place the trade, even if it is for 6 months at a time.
That is right. Yes.
Okay. So two more questions, and we can move on. Francesco asking, in my experience, to take a mean reversion position after a high volatility day will actually improve the performance for the next day.
Well, that's depends on your definition of volatility, because what I'm looking at is fixed. It's not the realized volatility. It's the implied volatility. So while, of course, typically when you have an extremely volatile day, the fix will also go up, but they still measure different things. The fix is really measuring tomorrow's expected volatility rather than the historical volatility or the realized volatility. So both you and my observation could be true at the same time.
Okay, and last question, Michael's asking, does the flip side mean that it's also true that you should have momentum strategies when the VIX is higher than 35?
Yes, that is quite possibly true. I find that momentum strategy does benefit from tail risk. The more tail risk there are, actually the better momentum strategy is supposed to perform. So I haven't studied carefully, using the fixed index, but potentially that is a correct observation.
Would it go? Here's my own question: would it go both ways? I mean, both extraordinarily high VIX as well as below average for bullish.
I wouldn't say that. For momentum strategy, you would only want it to be higher fixed. You might want to say that unless the fix is higher than a certain level, let's forget about trading momentum strategy. Maybe you would, or maybe you want to double the capital when the fix is higher than a certain amount when you're trading momentum strategy. Right.
Okay. Yeah. All right. Let me see. There's one last question. Helder asking, can you use the VIX in Forex? And you already said that yes, it worked in your research. It worked for high yield bonds, Forex, and currency and equities, right?
Correct. Yes.
Okay. Okay. So let's move on. Thanks, Ernie.
Okay. Okay. Thanks. So enough about VIX. Let's move on to a more perhaps exotic, risk indicator. Exotic to some, but maybe familiar to others. Order flow. Okay, so what you hear about the term order flow a lot in the discussion. I think one of the talks in this series was also about order flow. But what exactly is order flow? That's actually a very precise definition. Order flow is signed transaction volume, and the unit of measurement in order flow is dollars, right? Because transaction volume, of course, is measured. It could be measured in dollars, instead of shares, and you just put a sign to it. So when an order is executed at or near the ask price, the order flow will be positive. So if it's 100 shares is executed at the ask price, we'll say that the order flow is 100 shares, or if you convert it into dollar terms, maybe it's $10,000, this 100 shares. Okay, so that's the order flow. If the order is executed at or near the bid price, the vice versa, the order flow will be negative. Now, what is this concept of executed at ask price or bid price? The idea is that if the order is executed at ask price, that means that there's someone executing a market buy order. It's willing to pay at the ask price the aggressor is the buyer. And why is this person so interested in buying so aggressively? We have to assume that because it has private information, because he thinks that he or she is smarter than the market, because they think that something is going to move the market, so they are in a big hurry to buy. If it is just some mean reversing trader, we don't know anything. We just want to earn the spread. We are just scalping. We wouldn't be buying so aggressively. Okay, so that's the rationale of why order flow is predictive. It is that the person who is aggressively buying or selling must have known something that the general market doesn't know. And so we rely on their execution method to gauge which way the market is going to go. So that's the intuitive reason why order flow is indicative or predictive of price movement. And in fact, that intuition was borne out by academic research. They have found that order flow is a leading indicator of price change. In particular, if you look up a book on Forex by Richard Lyons, published in 2001, he will explain to you, present all the evidence to you in excruciating details. Now, as I said, the reason why order flow is predictive of price change is because breaking news cause informed traders to issue market orders. These informed traders may be bank traders. Maybe they have a high-speed subscription to all the macroeconomic news release, or maybe they have, they just sitting in on the conference call with certain executives of a company. So they are the first to know about breaking news. They are the first to sell or buy because of those news. And this kind of flow, a lot of times they have a name nowadays in HFT circles. They call it toxic flow. When you hear the term toxic flow bandied about by the traders, that refers to order flow that is generated by informed trader. Essentially, a toxic flow is informed flow because people know what is going on. They are not just a liquidity provider. Okay, and because this predictive property of order flow, it can be used as a high frequency leading indicator. The fix, as I said, is a fairly low frequency leading indicator. You can use it only once a day. I haven't figured out how to use fix to predict what is going to happen in the next hour, not to mention the next minute. But order flow, if you're trading intraday or you're trading at even shorter term, can be used as a high frequency leading indicator because the order flow of this minute can be predictive of what the price change will be in the next minute.
So, sorry.
Yes, go ahead.
A couple questions, as you might guess. So the time frame that you're talking about is primarily minutes, maybe an hour?
Now that's a good question because it is a matter of research, and I can't say I know the precise answer whether 1 minute order flow is better than 5 minutes or better than an hour.
Okay.
But all I can say is that it should be a short term. It should not be more than an hour and in fact it depends very much on your predictive horizon. If you're trying to predict the price change in the next minute, I do not think that is necessarily useful to use the order flow average over 3 hours.
Sure.
You might, yeah. So this is in some sense depending on the predictive horizon as well.
Okay. And what about what a lot of people commonly call cumulative delta, which is where you take the market orders executed at the bid versus the ask, and you run a cumulative total, for the day or even for longer periods. It's kind of similar to what you just talked about in some ways. Any thoughts on that?
Yes, I think that's probably equivalent to the definition of order flow I talked about. Yeah, because well, of course, there's a problem in that a lot of times it's impossible to determine what exactly is a market order because the executed price may not be exactly at the bid or ask. Right? So there's some fussiness there, but the concept is the same.
I guess I don't want to go too far off topic, but I guess whenever I looked at cumulative delta, which I did for quite some time, at the end of the day, I don't use it anymore. And that could just be because, I don't know how to use it, or it just doesn't work for my personality. But my biggest issue with it, if you will, is if you look at, like, for example, a chart of the ES versus a chart of SPY, the delta can be completely different. Not even close. I mean, the correlation is very low. So how do you make sense of that if you see, for example, really high delta or a lot of positive flow coming into SPY but negative on ES? It's really difficult, given the nature of both instruments anyway. Do you think that it works better maybe, in just regular equity class products, or what are your thoughts?
Well, I find that really strange that this discrepancy occur. I have not seen it before, but how did you compute this?
Okay. Basically just a chart of ES and a chart of SPY, and looking at a cumulative delta indicator, which just measures the volume at the bid versus the ask. And, they were completely uncorrelated, which also surprised me, by the way. So maybe that can, I'll maybe follow up with you in a week or two if you want to take a look and see what you think. I thought maybe it's just because it doesn't work in that market. That's the market that I primarily day trade. So maybe it works fine if you're just looking at, Apple or Google. I don't know.
Well, I think that this particular indicator works best in Forex, in futures. And that is because there's only one market where you can execute on the futures. It's very clear if, it's a bid or ask. In the equities market, including SPY, there are, so many markets and so many dark pools that I do not see how, one can really compute the flow in a dark pool.
Right. Okay.
Because, so that's a problem.
I'll try to take a couple screenshots and I'll forward them to you, and then we can, maybe discuss it later. Thanks,
okay,
Ernie.
that sounds good. Yeah. But let me just make one more comment, is that the whole purpose of dark pool is constructed to shield order flow from prying eyes.
Right.
And so that's, that makes it very difficult to compute order flow in the equities market, actually. Okay, but that aside, let's, just to flesh out the concept of order flow, if for risky assets such as ES, peso, and the high yield ETF, if institutional investors anticipate bad news, the order flow will be very negative for risky assets. But it will be very positive for riskless assets such as the US Treasury, US dollar, yen, and the Swiss franc. So in other words, you can use the order flow on these risky versus riskless assets to judge whether you should be getting into either asset, right? So if you have a very negative order flow for the risky asset, chances are you should refrain from getting into it, into a long position into these risky assets. But there's, of course, with order flow, as unlike fix, which is published for all to see every second, or low or shorter, the order flow can be quite difficult to compute for us. And the reason is that oftentimes you need to capture tick-by-tick data to compute order flow. And most broker, at least most retail broker, do not actually publish tick-by-tick data either in real time or as a historical data feed. It's just not available unless you are subscribing to some pretty good data provider. For instance, I trade on Interactive Brokers, and I know a lot of retail traders like to use Interactive Brokers. Well, I can assure you that they do not publish tick-by-tick data in real time, so you can pretty much forget about computing order flow from them.
IQ feed is really good. That's what I use, and it's tick by tick. They've got well, I don't want to go off topic too much, but I've used it for years, and I think it's really fantastic for equities, Forex, and futures.
Yes, I agree with that. Yes, I've heard a lot of good things about IQ feed. It's very reasonably priced, and indeed it is a true tick stream. Yeah. Well, in the Forex market, there's even a worse problem. Is that most Forex market do not publish trade price in real time. They might publish it with a 1 second delay, but by the time you publish it, it's no longer contemporaneous with the bid-ask, so it's hardly any useful. It's not particularly useful for computing order flow anymore. So how, theoretically you can't compute order flow in the Forex market except after the fact, but of course there is also the Forex futures that you can use as a proxy. So instead of using the spot market to compute order flow, you have to use the futures market. So, well, that's all about order flow. It's upshot is that it's not easy to compute, but if you are able to capture tick-by-tick data, you might be able to use it for intraday use it as an intraday leading risk indicator, as opposed to the fix, which is really a daily risk leading risk indicator. So the conclusion, let me be pretty quick, is that you can actually find a very simple risk indicator that can predict risk, not just tell you what the risk is currently, but predict risk so that you can avoid getting into the market. But there's a caveat, which I haven't mentioned. The caveat is that these extreme events, by their very nature, occur very rarely. So it is very easy to have data snooping bias when you incorporate this kind of leading risk indicator. So anybody can propose an indicator that can avoid 1 or 2 events, but would it avoid a future tail risk? Really, it's hard to know because you don't have enough occurrences of this kind of extreme event to tell you whether they really work consistently. Okay, so that's a big caveat in employing this kind of risk indicator for tail risk. And then, of course, no number of financial indicators can predict terrorist attacks or natural disasters. Those will have a big effect on the market, and no one can really know. So none of these leading risk indicators is useful in those circumstances. And also, we should not just rely on these indicators to avoid risk, because sometimes they may not capture all the tail risk that there is. So there are other tools for risk management, which I've talked about before, Kelly from constant proportion portfolio insurance. And finally, perhaps the most foolproof tool for risk management, which is options. Options has this problem because it's expensive. So, but if you manage to find cheap options, that's a pretty good insurance policy. And that's it for the talk. And please do keep in touch. My contacts are here, and do come and read my new book. So thank you very much.
Thank you very much, Ernie. So let's open it up for general Q&A, and then as soon as we finish with that, we'll move on to giving away the 10 books. So let me see what I've got on the screen here. RR asking, can you please give examples of instruments that perform well using mean reversion strategies? So, I mean, you covered a wide array, well, pretty much every product class. Do you find that any one works better than the other, or any that don't work very well?
Well, I think mean reversion happen most often in, for example, in pairs trading. ETF pairs, for example, has the most stable sort of mean reversion. So yes, pairs rather than individual instruments, and but in particular ETF pairs.
Okay. Tim is asking a question, and Tim, I'm not sure I understand. Maybe Ernie will. He says, does the academic research using volume buckets or bars instead of time bars and calculation of pin, is it now relabeled VPIN?
Yes, I have found that they are, they don't make that much of a difference. But since they don't make much of a difference, whether you use a volume bar or time bar or text, certainly it's easier to compute volume bar than text. So yes, I would agree that it's beneficial to use that technique.
Okay. Another question from RR. Can you give some pointers on how to compute order flow if you have tick data? So, Ernie, let me ask, what platform do you use?
Well, Well, there are two different answers. I mean, one is in historically and one is in real time.
Right.
With historical data, there are multiple algorithms for computing tech. The gentleman before just mentioned three, which is using tech data, using time bar, or using volume bar.
Right.
Using tech, the typical formula is that if the trade price is higher than the midpoint, okay, higher than the midpoint at that time, you count that as a positive flow. It doesn't have to be exactly executed at the ask price, but as long as it's higher than the midpoint, you count it as a positive flow, and vice versa for lower than the midpoint. If it falls exactly at the midpoint, then the order flow, the sign of the order flow is the same as the sign of the previous order flow. So there's a technical algorithm for computing it. If you Google order flow computation, you should find some academic papers for that. Yeah.
Okay. Are you using TradeStation for this?
No. When I trade in the Forex and have to, if I trade in Forex, we have access to live tech data. Then we actually, I'm sorry, I take back what I said. Not when I trade with futures, we still use interactive brokers, but we have a very approximate order flow that we compute. So,
okay.
Like I said, it's very cross-grain order
okay.
flow.
So most of the people on BMT are using NinjaTrader. CR Chart is also quite popular. Market Delta. There's all three of those platforms. I would say those are the most popular on BMT, and they all either have built-in, or in the case of NinjaTrader, have a third-party tool that is commonly called cumulative delta, and I think that's pretty much exactly what you're describing as just order flow, where it measures trades. You can set it to either tick volume or God, I'm going blank. I think it's trade volume, and see the difference between orders that come across at the bid or the ask. So that sounds like what you're talking about. As far as a historical data, like you mentioned, there's not many brokers that have very good. Well, first of all, not very many good feeds at all, even for real time, but especially historical. And interactive brokers definitely not being a good one.
That's right. Yes.
But IQ Feed is very popular. It works with all three of the platforms that I just named. A lot of people use it on BMT. So that would be one way if you guys are interested in trying to get that data. Okay, let me see what else we've got here. Helder asking if you could repeat the name of the book you mentioned earlier from or authored by Richard Leon.
Okay. The name of the book. Let me.
I remember you said he went into excruciating detail.
Let me. Well, I have to Google it myself. So,
okay.
Richard Leon. Let me see.
Is it the microstructure approach to exchange rates?
Yes, that's it. Yeah.
Okay. All right, let's see. A couple other questions here. BP asking, what do you use to model fat-tailed return distributions? Is it a logistic distribution or a general stable distribution?
No, if you want to measure the kurtosis, it's a empirical statistical measure. You don't have to model it as any particular distribution. So if you use MATLAB, for example, there's a function called kurtosis. It can apply to any empirical distribution. There's no need to assume any parametric model to measure it.
Okay. Tim asking, if the data does not lend itself well to interpretation by a normal distribution because of high kurtosis and the presence of fat tails, why not use another distribution type as an example, an exponential distribution where one could also calculate the probabilities, although in different ways.
Yes, I mean, my focus is not on how to model the returns distribution, right? No matter what is the best distribution you could come up with, the fact remains that there is a fat tail.
Right.
My problem is not that I couldn't find a distribution that can model it correctly. My problem is that the empirical distribution has a fat tail, and I want to avoid suffering that tail.
Right. Okay. All right. So I don't see any of the questions on the screen. So before we move to the prize for the 10 autograph books, let me just say one more time, thank you, Ernie, for putting together the presentation and for answering everybody's questions today. And if anybody did not get their question answered, then you can contact Ernie right there. It's his email address and his website. And with that, if it's all right with you, Ernie, I'm going to take back control and throw up the quiz questions, okay?
Sure, please. Thank you, Mike.
Thanks. All right, guys, give me 1 second to do that. And Ernie, I'll leave your mic on in case you want to add anything to the answers here that we'll be giving.
Okay.
Let's see. All right, so the prizes today are 10 autographed copies of Ernie's brand new book. I will be asking the winners for their BMT username, so have that ready, and that's how I will get a hold of you after the webinar to get the book into your hands. And guys, it's one book per person, so please keep that in mind. All right. Question 1. Why are mean reversion strategies more prone to tail risks than momentum strategies? And we're looking for a solid answer here, not 1 or 2 words. Okay. Still not got quite the right answer here. There we go. There we go. Okay, so Greg Dance, I need your, whoops, everybody, there we go. Greg, I need your BMT username. So the answer is the absence of natural stop loss and mean reversion strategies, or stop loss decreases returns and mean reversion strategies. Okay, Greg, let me write that down. Hang on. Okay, let's go to question 2. What statistical measure captures tail risk? Okay, I knew you guys would get that. We talked about it a lot today, so we have the answer. I'm just trying to get my screen to stop moving. James F., I need your BMT username, please, and the answer is kurtosis. Okay, let me write that down. Okay. Going to question 3. What makes the Mexican peso more difficult for mean reversion strategies than equity index future? Yes. Okay. Okay. Jonathan W., I need your BMT username. I think that your answer was very, very close. So the answer is that the peso has a higher kurtosis than the ES, while the normal volatility is lower. So I need your username. Okay. Hey, I know you. Okay, going to question 4. If a strategy has had positive daily returns from January to May with a year-to-date return of 10%, but lost 15% in June, what is the maximum drawdown since January? All right. Lawrence, oh, I'm sorry. Somebody beat you to it. RR, I need your BMT username. And so the answer is 15%. So waiting for RR's username. Okay, that's your email address. Your username should be different. Okay. All right, going to question 5. Which of the returns histogram below has a higher kurtosis, assuming they both have the same number of total bars? Okay, we've got the answer. The answer is the right one, or B. And Michael S., I need your BMT username, please. Okay. Okay, going to number 6 here. Is normal volatility good or bad for mean reversion strategies, and why? So you've got to give the reason as part of the answer. Okay. I'm looking for the best match here. Just hang on one second. Lots of good answers, so I'm just doing my best here to make a subjective decision as to which one matches the answer given by Ernie and Greg T. Greg T., I need your BMT username. So the answer that Ernie gave is good. Higher volatility generates more trading opportunities, and higher deviation from the mean generates more trade per profit. And let me write that down. Okay, going to number 7. What are the inputs to computing the VIX? So how is the VIX computed? Okay, we got it. Oleg M., I need your BMT username, please. So the answer is calls and puts in the index option. Okay, let me write that down. Okay, number 8. If we submit a buy limit order for 100 shares to the order book and it gets filled after 5 minutes, what is the likely order flow due to this transaction? We're looking for a number. Okay, there we go. Kind of a trick question. Okay, Dirk S., I need your BMT username. So the answer is -100 since the aggressor is a seller and the transaction takes place at the bid. Okay, let me write that down. Number 9, if order flow is is order flow a leading or lagging indicator? Okay, we got the answer. JPN. JP, I need your BMT username. The answer is leading. Okay. And here comes the 10th and final. Can we compute order flow on a FX market, and why? We need the why. This is not just yes or no. We need the reason. Okay. Trader Duck, I'm assuming that is your BMT username. Let me know if that's not right. And so the answer is no, most FX markets do not provide trade prices. Okay, so congratulations to the 10 book winners. I'll get in touch with you shortly to get the autograph requests, get those requests over to Ernie so the books can be signed. Ernie, once again, thank you very much for all of your time today. And I hope to see you back soon. Do you have any more books planned, or are you taking a break for a while?
Taking a break.
I thought that might be the answer.
Yeah.
Okay, man. Well, I'll see you back hopefully in a few months. And until then, I'll see everybody on the site. Thanks, guys.
Okay. Thanks for coming. All right, bye.